for this webinar and also introduce our guest, Mr. Parag Dhol. Parag is a managing director at Inventus Capital Partners, a venture firm that invests in entrepreneurs building global tech-focused companies in India and US. At Inventus, Parag is a board director at redBus, FundsIndia, Vizury, eTechies, Savaari, Power to SME, PolicyBazaar, and eDreams. He is based out of Bangalore. Parag made a foray into venture capital after his MBA in 1993. He started off with ICICI Venture and followed that up with stints at GE Equity and Intel Capital. Parag has a BTech from IIT Delhi and is an MBA from IIM Bangalore. Before I hand over the floor to Parag, here are a few reminders to the audience. You will all be on mute. You may ask questions by typing in the panel provided. Over to you, Parag.
Thank you, Sneha. So thanks to NEN for giving me this opportunity. It's good to speak with you. As Sneha mentioned, I'm Parag. I'm from Inventus Capital. And what I'm aiming to cover in the next 30-odd minutes is the top 10 things in the term sheet, which was the topic allotted to me. I think before I start and go further, the image on the first page is, I think, what I wanted you guys to focus on. This process of negotiating a term sheet, looking at one, being surprised at the terms out there, etc., can get very easily confrontational, especially for a first-time entrepreneur who hasn't seen things like this before. It can come as a surprise, a nasty surprise at times, because some of the terms at first glance look fairly onerous. But if you look at it from the perspective of the venture capitalist who's investing money that belongs to somebody else as a fiduciary of someone else, and the fact that the venture capitalist does not really have a day-to-day control over the business, which you as an entrepreneur do, you will begin to see things from the other side of the story. You will begin to have empathy, so to speak. So that is the thought that I wanted to start with. The fact that this is a term sheet is the beginning of what will hopefully be a fruitful relationship, and try not to convert this into a game of one-upmanship, game of negotiation, or test of manhood, if you will. So with those opening thoughts, I will dive into the top 10 things. First one that comes to mind is clearly valuation. I think that is the key point in that people focus on, almost to the exclusion of everything else in a term sheet. So this slide of mine, which I hope you can see, is kind of represents two scenarios for an early stage company, and I wanted to kind of illustrate to you why over-focusing on valuation as the only criteria is probably not right, especially for an early stage entrepreneur. So the example here is that, let us say you are raising $1 crore for your business at a very early stage. You are maybe 6 months into company formation. You are trying to raise $1 crore for taking you through your journey for the next 12 months. And there are two scenarios. One where you're shooting for a 9 crore pre-money. The other, you're shooting for a 4 crore pre-money. Or let us say you were shooting for a 9 crore pre-money, but you actually got a 4 crore pre-money. So what that means is, in the first instance, what you were trying to give away is 1 divided by 9 plus 1, which is 1 divided by 10% of the company, whereas the venture capitalist came back with a number of 4 crore pre-money, which becomes 1 divided by 4 plus 1, which is 1 divided by 5, 20% of the company. Now, on the face of it, 9 versus 4 look like numbers that an entrepreneur should never accept, and this tends to become an ego battle. This tends to become a battle of manhood, whatever. But I think if you look closely at the pie charts, what you will realize is, and to keep it simple, I've just focused on 2 parties here. They might be ESOPs, there might be other passive shareholders. So I've kept them out. But if the founders own the balance, whatever the VC doesn't own, then in the first instance where you were expecting a 10 crore post or a 9 crore pre, you end up with 90% of the company, and second you end up with 80% of the company. Now look at it this way: if you don't make money at 80% of the company, it is unlikely that 90% of the company will drastically change those odds. On the other hand, for the VC, 10% to 20% is a doubling of the odds. Okay, so I would want you as an early stage entrepreneur to focus on that fact, that as somebody who is coming into a business at an early stage where faith, trust, belief in you is far more important than what you have produced so far, at that stage, I think the ability to double your odds while not double the other person's odds, while not impacting your odds drastically, is something that you should focus on. I mean, it's something that you should consider. So this ego battle of 4 crores, 5 crores pre-money, 6 crores pre-money, etc., is when you think that through in your head, what I would want you to think is from the other perspective, from the other guy wearing his shoes, so to speak. And that's where I think this at times this becomes a really critical battle, so to speak, ending up at times even in relationship breakdowns, etc. But I just wanted to share my perspective on valuation here. I should say that this might not be very applicable for scenarios where somebody is expecting 50% of the company. I think an angel or a VC investor should know better than to ask for 50% of the company. That's the first thing. Second thing, in a more advanced company, when the company is, let's say, 3 years old, 4 years old, has 10, 15, 20 crores of revenues, much more predictable, risks have been removed, some of the risks, majority of the risks have been removed. Clearly, at that time, focusing on valuation is not misplaced, I should say. But at a very early stage, trying to super optimize valuation is something that I would advise against. So I'll now move over to the second point, which is liquidation preference. So at times what happens is the battle on valuation seems to be the main battle, and people forget to fight the other ones, or people forget that there are other things that could change the economics, and liquidation preference is a classic one where this happens. While I've given an example where it doesn't impact hugely, but if I were to, instead of I were to change the numbers around a bit, you will realize that this could change the fortune. So how liquidation preference works is that, let us say I'm now taking a similar example like that in the valuation sheet. You are raising a crore. Eventually, between the VC and you decided that the post money will be 5 crores or pre-money is 4 crores. So the founders own 80% of the business, the VC owns 20% of the business. And let's say some X years later, there is a sale of the business at 20 crores. Okay, these are just hypothetical numbers. 20 crores in particular is a hypothetical number, just to illustrate the difference between the two types of liquidation preference. One is called as a participative liquidation preference, and the other is called a non-participative liquidation preference. So what that means is the column chart on the left, which shows 1x participative liquidation preference, and the column chart on the right, which shows a 1x non-participative liquidation. In effect, what happens is, because of this participative feature in the liquidation preference, the VC tends to get a higher percentage of the proceeds. 20 crores is the proceeds in this case. The VC ends up getting 4.8 out of the 20 crores instead of about 24% of the consideration instead of the 20%. So how does this come about? How the mathematics works here is that a 1x participative LP works this way. So 20 crores is the consideration. 1x means the investor invested 1 crore. So the first thing that goes out of the 20 crores, think about it as a stack of money or a stack of books, as I have put on the right. Out of the 20 crores, the first thing that goes out is 1x. So 1 times the money that the VC investor invested, which is 1 crore. So 20 now becomes 19. And that 19 is then split in the ratio that the VC and the investor had, which is 80-20. As a consequence, 1 crore plus the 20% of 19 crores leads to a 4.8 crores for the VC, and the balance, which is 15.2 crores for the founders. In the other simple instance of a non-participative liquidation preference, as long as the exit amount is more than 5 crores, what will happen is that it will always be pro rata. How this one works is that this is a fairly simple thing. At less than 5 crores, obviously the VC gets the first crore first before you get the balance. So if the company is sold for 4 crores, for example, then the split would be 1 crore and 3 crores in a 1x non-participative LP. But anything beyond 5 crores is split of strategic sale value is split 80-20 between the founders and the VC. So just this participative feature can lead to a change in the economics of the deal. Now there are many other ways in which you can change the economics. For example, the 1x could actually be a 2x. In a very bad case, if you are dealing with some tough VCs in a very tough environment, then that number could even be a 3x. So that changes the economics clearly. One of the other ways in which the economics can be changed favorably from the founder's perspective is to tell the VC, fine, I'm okay with the participative liquidation preference, but as long as you make more than 5x on your money or more than 10x on your money, beyond that it should be pro rata. So that could be one of the negotiation considerations that could go in. I am essentially, just to repeat myself, essentially to say that the participative LP will be there till you make 5x your money. That is the cap, beyond which it will be pro rata. So those are some of the ways in which economics of the underlying valuation discussion that took place in the previous chart can be changed by changing around the parameters around whether how many times is it 1x, 2x, 3x, or is it participative or not participative, or is it participative with a cap or participative without a cap. So that was the second major term that in my view you should focus on. I now come to the third one, which is, in a sense, I have clubbed two of them, which would be called control provisions. As I started off saying, VC typically does not have a control of the business. It is the founders who remain day-to-day control of the business. So what the VC is attempting to do is a pseudo control or a pseudo protection of his interests. I shouldn't call it control, but it is a pseudo protection of his interests because of the information asymmetry between the founders and the VC. It is the company is run day to day by the founders. The VC only has limited visibility at the end of the day. The VC is trying to balance it out through these mechanisms, through these control provisions that I'll touch upon. One of the ways of doing it is the board composition. Let us say there are two of you who started off. One VC joins in with $1 crore in my example, and he takes 2 board seats, and you agree on a non-even board, an odd board of 5 people, where there are 2 founders, 2 VCs, and 1 independent, so that it is a kind of a balanced board. So the VC doesn't kind of overrule your decisions at the cost of propriety, or you as founders do not kind of bulldoze the VC, because each of the 5 of them have a vote each. So it is only if the independent agrees with one side does that side. If there is a conflict in the first place, only if the independent agrees, independent being somebody that is jointly appointed, only if the independent agrees with either side, is a conflict kind of settled in one direction. So that is one way. That is one way in which board control is achieved, or a board split is achieved, so to speak. The other way is what are known as protective provisions. People call it veto rights, etc., etc. These are rights that this is almost like a veto that a investor has for major decisions. For example, if you want to do an IPO of the company, or if you want to sell off the company, then obviously the investor should have the right to say yes or no to that decision. Remember that each of these protective provisions is only a yes or no, the VC saying yes or no to something that you as the founder suggest. So you are suggesting the IPO, or you are suggesting that, okay, this company wants to buy me out and I think I am keen. Now tell me, Mr. VC, does it work for you or not? So that's the dialogue that is going on. Future financings is something that you would want a veto on the VC, that is amendment to any rights attached to the shares or any changes to the memorandum and articles of association of the company is something that a VC would want a veto on. The annual budget needs to be approved with the VC, because clearly cash, how much cash is used in a particular year is one of the more important decisions, and how the company grows from last year, etc., etc. So budget is something that you would want to control. He would want to say yes or no to, I shouldn't say control. You wanting to get into a new business, VC would want to have her say related party transactions between the founders and say his wife or somebody else in the family. That's again something that the VC would want to say yes or no to. The fourth aspect of a term sheet that I wanted to touch on is this clause called anti-dilution. So here what happens is, the situation is, I presume you understand Series B and Series A. So in our example, the 1 crore raised at 4 crores pre-money was Series A, and let us say there is a subsequent round 2 years later called Series B, and in that Series B, unfortunately, the share price because the company has probably not performed, so the incoming investor in Series B pays a lower price, a 20% lower price in my example, than the Series A. So in our Series A, going back to the same example, 1 crore raised, 4 crores pre-money. Let us say the company had 5 lakh shares in total, then it was at 100 rupees a share. But 2 years later, another investor comes in, the company is not doing too well, this Series B investor is only willing to put in, let us say, 3 crores of money at 80 rupees per share. Now, what happens to Series A is the question. I mean, does it convert only at $100 a share, or does it convert at a lower price, etc.? Is the crux of the anti-dilution clause. And if you look at my scale on the left between 80 and 100, there are various forms of adjustment that can be made to the Series A price. The worst from the entrepreneur's perspective being full ratchet, which basically means that the Series A price will adjust to the Series B price if the Series B price is lower. So basically, instead of converting at 100 rupees a share as originally envisaged, now the 1 crore would convert at 80 rupees a share. Weighted average is another method to do it. Two forms of weighted average are broad-based and narrow-based. So a broad-based weighted average would get you closer to the 100 as distinct from as far away from 80, whereas a narrow-based weighted average would be closer to 80 than to 100. I won't get into how specifically these are weighted, etc., etc. It becomes a complex formula, which is generally available on the internet. So it's not that complex as such, but in essence, the message here is that the three methods, full ratchet, narrow-based, and broad-based weighted average, are essentially ways to adjust the Series A price in case there is a round in future, which is at a lower price than what the Series A investor paid. And there are spins on things like this. So, for example, a VC investor coming in might say, okay, I gave you money for 18 months. I mean, this 1 crore of money should last 18 months for this business plan. So for the first 18 months, I will have a full ratchet anti-dilution, but going forward, I will have a broad-based weighted average dilution. So that's another way in which this can be mitigated, and you can negotiate around that, whether it is 18 months, 12 months, etc., or whether it is always full ratchet, or whether it is always broad-based weighted average or narrow-based weighted average, etc. I've seen narrow-based weighted average being rarely used, at least in India, but full ratchet and broad-based weighted average are the ones which are kind of held as most common. But some entrepreneurs have gotten hurt by this clause without realizing what they signed up to in the first place. So that covers the fourth key item that I wanted to cover. The fifth one, if you can see my slide, is on exit rights. Our perspective here, we VC investors are basically, like it or not, are kind of exit has to be one of those events that we have to think about right from day one. While we are investing, we are thinking about exit. So, but that is how the VC model works, because ultimately you raise money from people like us VCs raise money from what are known as limited partners and have to give back the money. So eventually the model is to invest in a company and harvest that money and give it back to the limited partners, and consequently exit is a key part of every VC investment. And it manifests itself in the term sheet and in the definitive documentation as various exit rights that an investor would have. So, for example, your term sheet would probably say that this company, we expect this company to be listed on a stock exchange at a minimum market capitalization of 200 crores within 5 years from now, or to be sold to somebody at a minimum price of 200 crores within the next 5 years. So those are the two definitions of qualified IPO. Qualified being it's just not just an IPO, but it is also defined as an IPO with a minimum pre-money of 200 crores in my example. Or a strategic sale is defined as a sale of the company with a minimum valuation of the company of 200 crores in my example within 5 years from the date of the investment. So that is an exit right that is kind of something that comes along with every term sheet. The other exit rights are the other one that happens, which is kind of time related, is the drag along right at the end, which I have called a Brahmastra, which is hopefully rarely used. Drag along is something, let us say 5 years later, nothing is happening, the company is not doing too well, but there is a buyer on the horizon who wants 100% of the company. I own only 20% of the company, but that buyer wants 100%, otherwise he is not interested. So what the drag along helps a VC investor to do is to force the entrepreneurs also, the founders also, to sell along with him if the buyer wants a specific stake. For example, if he wants 51%, then in our example, 20% will come from VC and 31% will come from the founders, and founders are obliged, as long as that time period of 5 years that is given for a qualified IPO or a strategic sale, that has elapsed, so to speak. So a drag along is kind of a right which is like the Brahmastra, used only in extraordinary circumstances where you want to get out. There's an opportunity to get out as well, but the company has probably not created enough value. So you're trying to, and since the buyer wants a larger stake than the VC owns, they would want to, the VC would want the founders to sell part or whole of their shareholding. The other exit right that comes along is more because of what the founders do. Let us say one amongst the two founders wants to exit for whatever reason. It could be a personal reason, he doesn't believe in it, whatever. He wants to sell, has identified a buyer. Then the VC would want to do two things. I mean, one of two things in that scenario. The first thing is that he would want a right of first refusal. So, for example, out of A and B as the founders, B wants to exit and B wants to exit at rupees 200 per share. Then the VC would have the right, B has found a buyer at 200 rupees a share. Then the VC would have the right, not the obligation, but the right to buy those shares from B at 200 rupees a share. Alternatively, what the VC can do is he can tag along, he or she can tag along, which is, what that means is, let us say B held 40% of the company, okay? In my example, he's willing to sell 40% of the company. Then, the buyer has made an offer at 200 bucks for 40% of the company. Then this right will say that since our ratio of shareholding is 40:20, 40% for B and 20% for the VC, you should sell only 2/3 of your shareholding, and we'll sell 2/3 of ours. So combined total, since we own 60% in total, 40% is being sold. So 2/3 you should sell, 2/3 of ours we will sell. So you sell about 26-27, we'll sell 13 or 2/3 each, and we'll get out at the same price. So a VC investor in that circumstance can choose between either buying founder B or selling along with founder B. Selling along with founder B is called tag along, and buying founder B is called, in my example, it's called right of first refusal, which is put there as ROFR in short. Those were the five, in a sense, five key rights. Give me a second. Hi. Is that, yeah?
Yes, Parag.
Okay. So I'll just take another 3-4 minutes. Is that fine?
Sure. Absolutely.
Okay. So on the those were the 5 key rights that I wanted to cover in some detail. The others I have put in others very quite obviously. I think they take majorly 2 forms, either economic rights or others under others. So this is becoming, I guess, a loop. But anyway, economic rights could be things in terms of expenses. For example, you should be wary of a VC investor who says that I am investing 1 crore in the company, but my legal due diligence and financial due diligence will take, because of the agencies that I appoint, will take 20 lakhs away. Okay, so if the he's investing a small amount, if a large amount goes to as expenses, then you should be wary, I would assume. The second economic right, so to speak, or economic element, if you will, is the ESOP pool, which serves as a negotiating tactic. So basically, the investor would want it to be done before. He wants a pool to be created of 20% of the shareholding of the company before the money comes in. So in my 40 A, B, and 20% example, he would want A to go down from 40% to 30%, B to go down from 40% to 30% again, create a 20% pool, and then have his 20% on top. The other way to do it could be post, where A, B, and the VC hold 40, 40, 20, and then there is a 20% pool on top, in which case the VC goes down from 20% to about 16-17%. So those are that is another point of negotiation. Some of the others that could impact an entrepreneur could be exclusivity. Every VC, when he signs a term sheet, would want an exclusivity time. How long should that exclusivity be? Is it interminably long, where in case the deal doesn't work out, it impacts your fortunes? Those are things that you should consider. Conditions precedent before money comes in also becomes a consideration. For example, if the VC says, throws in a term sheet at a very early stage after just 1 or 2 meetings with you without having done proper due diligence, and then says that no, this term sheet is subject to technical due diligence, meeting with my partners in the US, etc., and 100 other conditions precedent, you should, the body language is not good. If you have an option, think about that option. The instrument at times, especially in India, where they like to say we tend to postpone the problems, especially around valuation. Some people, what they will do is they will come up with a convertible structure based on your performance for financial year 2015. We'll give you 3 times your revenues or 15 times your profits, whatever the case may be, and we'll do it that way as an instrument, instead of putting in a straight equity 20% of the company in my example, etc., etc. We have a preference for simple stuff because it kind of aligns the entrepreneur's interest and ours. I'm not saying convertible is the wrong thing to do, but you will find 2 kinds of views. Some people do convertibles, and some people who want to finalize the deal here and now and move on in life. So those were the top 10 things that I wanted to cover, 5 in some level of detail, the others kind of in brief. I'll take a minute to kind of describe who we are. We are a technology-focused venture capital firm based we operate both in the US and India. We are early stage investors, typically in companies which are in the first, maybe second year of revenue. In case of services companies and product companies, we go slightly earlier. Areas of focus are mentioned there: internet, mobile, software, and services. 3 to 15 crores is what we start with. Total over multiple rounds, 25 to 30 crores. Team Three of us are based on Sandil Road, and three of us are in Bangalore, in Bangalore. We have 20 investments in total now, 8 in the US, in companies that have an India connection, typically either in terms of leveraging talent or selling into the Indian market, and Indian companies are either selling into the Indian market or selling overseas. The greens that you see there are the 3 companies that have exited. One of them you would have read about recently, and you can find us at that link there, inventusvc.com. Thanks for your time. I can take questions now.
Thank you, Parag. We'll start with the Q&A now. Our first question is from Mr. Manoj. He asks, what will be the difference with 3 investor board of director if company takes in terms of term sheet? What are the top 3 points to consider at term sheet for 3 investor board of director?
So Sneha, what does it mean? 3 investors are investing at the same time in the company?
Yes.
And, okay, so from as I outlined, I think the first 3 on my presentation should be the ones that you should focus on, I guess, and if you were to focus on. I think all of them are important, but the first 3, if you were to put a gun on my head, those are the ones that you should focus on. If there are 3 investors at an early stage is a lot, okay, honestly. I think you have to realize that 3 in the crowd is actually a pretty powerful thing, in the sense that it is really true. So because of the multiple opinions at an early stage company can get derailed with those many investors. So I'm assuming when you mention 3, it is a slightly later stage company where the points of difference are not likely to be that high. But the way you should do that in that circumstance is to have 3 of you and 1 independent. Ideally, make it as I said, odd numbered board with the same number of founders and the same number of VCs and 1 independent.
All right. So Parag, I think we'll wait because people are still sending in their questions.
Okay.
So do send in your questions.
Did I go too fast, Neha, or was it okay?
No, it was absolutely okay. There's another question. He asks, my startup is now going out for its first round of venture financing. What are the things that I should pay attention when negotiating a term sheet with the VC?
I thought I made a 30-minute presentation on that. so those are the aspects that you should focus on. But I think one point I would make here, see, chemistry is the most important thing. Does the guy sitting on the other side, the venture capitalist, really understand your business? Think about it this way. If a smart friend of yours comes into your office and doesn't know anything about the business, and what are the questions he asks about your business to get a handle of that business? Does the VC ask those questions? Do you feel comfortable with him? Is he does he cut you off? Is he is he abrasive? All of those kind of things are things that you should absolutely consider. You should also, just like we do due diligence on the company and on the founders, you should also do due diligence on the VC, especially if you have a choice. What do their entrepreneurs say about the VC? Does the VC behave, have a short-term thinking, etc. or not? So those are the softer aspects that I didn't touch upon, but those are very, very critical, because think about this as a 5 to 7 year marriage. Yes, it is not an Indian marriage which lasts 30, 35, 40, 50 years, but but this is nevertheless a pretty close working relationship for 5 to 7 years, and you should get, I don't need to tell you that a 5 to 7 year working relationship is something that you should do only when the chemistry is right. So focus a lot on the chemistry, because the other guy is also focusing on the chemistry, but it is also your responsibility for it.
Okay. Our next question is from Chaco. He says, any specific areas Inventus is focusing on in the telecom area?
So telecom would fall within the purview of what we do. I mean, obviously not putting up networks and things like that, because we are a small fund and we believe in capital efficiency, etc., etc. But telecom software, etc., is or a small piece of hardware, etc., etc., is fine within what we do. Our approach to technology in India has been that the market is an evolving market. It's at a nascent state, so we do not believe in over-focusing. We do not believe that we should do only cloud deals, for example, because I think that market is not deep enough. So we tend to look at a broad space of opportunities. Even if you look at our portfolio, there seems to be a lot of chaos there because they serve all kinds of verticals, they have different levels of technology adoption, etc., etc. So it has never been very thematic in that sense. So I think the best way is, if you are broadly in the technology area, to approach us, and we'll give you an answer as to whether it is.
Our next question is from Vineet. He asks, when is it advisable to create a pool of ESOPs, before or after funding?
So the way I look at it is, ESOPs are a good retention tool. As companies like redBus, as and when they get sold, ex-employees make a lot of money, I think people will start valuing them more than they value them today. At a point in time, Infosys ESOPs were worth a lot, but unfortunately things changed since then, etc., etc. But ESOPs, I consider as most of us consider as a good alignment of interest between the employees, the VCs, the founders, etc., because the long-term interests of everybody gets aligned there. So in my view, ESOPs should be something that you should do at an as early a stage as possible. I think today it is also an attraction tool for good employees. So you shouldn't link it to an event. You should not link it to an event. You should think about it as an employee motivator, attractor tool, rather than a tool that you need to display to the VC.
Our next question is from Vaibhav. He asks, is there a possibility of VCs investing in the very early stages of startups like seed funding?
So VC is traditionally defined. Let me answer that question for ourselves. We are more like Series A investors, not the seed or the angel investors. So three guys and a business plan is kind of not the stage that we have defined for ourselves. Right? This is not a value judgment. It's just something that we don't do. There are, on the other hand, there are these multiple angel funds groups, the India Angel Network, Mumbai Angels, K, Bloom, and others, who have cropped up, and there is a pretty healthy angel ecosystem developing in most cities in India. Bangalore is very, very healthy. Even Delhi is quite healthy. Bombay as well. At these places, the angel ecosystem is developing, and at the stage that you described, angel money is probably more.
Our next question is from Vipul. He asks, could you explain the concept of founder vesting?
Okay. So this is another alignment of interest between the founders and the VC, kind of a term, so to speak, one of one of the things in the term sheet, so to speak. So think about it very similar to the ESOP vesting. So let us say, even though you have the entire shareholding of the company, let's say you are the only shareholder, 100% before the VC comes in, 80% after the VC comes in. So what the VC will say is, see, Vivek, your name was, sorry? Who was the gentleman who asked?
Vipul.
Sorry, Vipul. So the VC will say, Vipul, what happens? I mean, I'm trying to cover for the possibility that you tomorrow just resign and walk away. That impacts my shareholding. It impacts the value of my investment terribly. So what the VC and Vipul in this case will agree is that over the next 4 years, the 80% in your company will get vested over a period of time. Let's say on a yearly schedule. To make it simple, it could even be a monthly schedule. So at the end of first year, if you leave for whatever reason, you will only own 20% of the company, 60% you will give back. If you leave at the end of the second year, then it will be 40% of the company you own. 40% of the shares that you held you own, 40% you give back, and 20% was originally held by the VC. And similarly, third year would be 60-20, and by the end of the fourth year, it would be 80-0. So that is the concept of vesting. It kind of it is seen as aligning the interests of the founder and the VC.
Our next question is from Chaco. He asks, how did Inventus contribute to the redBus story?
So, multiple ways. I think, the simplest is obviously the money at the right time, etc. I think Funny was a young entrepreneur. We had Kanwal on our side, who's an experienced entrepreneur. As the company grew, Kanwal had regular weekly chats with him, so to speak. This continued for the last 1.5 years, for example. So that was one way. We brought in, we obviously were part of the interviewing or the wooing process for most of the employees. One of our referrals became the chief product officer of the company, Alok Goel, who is also fairly well known. One of my partners here referred him. He's an ex-Google employee. We have he used to work at Google, Alok, and 2 of his colleagues are actually partners in our firm now. So we referred that, Bharat, etc., etc. So in multiple ways, in strategy, in helping recruit people, in helping Funny think through some of the decisions as a sounding board at the time of exit. So it is. You are in effect a good sounding board whenever the entrepreneurs bringing Helion into the equation, etc. You serve as a good sounding board and a good. You open up your Rolodex for Funny in various ways. So those are the ways in which I would say we contribute.
Our next question is from Shrikar. He says, do we have term sheets at each of the investing phases, like seed fund, angel fund, VCs? And how do we make sure there is no contrast if these are there at every phase?
Yes, there are term sheets at every stage. The difference between them will be the first one at the seed stage will look the most onerous. The terms should get milder over time if you perform in particular. Not only does the valuation of the company increase, but the terms should get milder over a period of time. And when I say terms, I'm using a weighted average of all that I talked about and some more like founder vesting, etc. So that should be the way in which you should think. But yes, at every stage there is a term sheet.
Next question is from Sharak. He says if a startup's development team and founder are based out of India, with co-founders in UK and targeting US-UK markets initially, followed by India, should the startup approach Indian VCs for investment? Would it work?
Sorry, could you repeat those geographies again?
Yes, so if the startup's development team and the founder are based out of India, with co-founders in UK and US, and they are targeting US markets initially, followed by India, should the startup approach Indian VCs for investment, and would it work? So the startup is basically, it is a product in the semantic e-commerce market.
Okay. So I think at least between the US and India, at least we speaking for inventors, and there are firms like Helion and Nexus which have similar structures in some ways. Between the US and India, we consider it a kind of a two legs of the same stool, if you will. It is like a set of Siamese twins. It is very closely joined together. So look for firms who kind of like us. It doesn't necessarily have to be us, but us is also fine. Look for firms who have this US-India kind of presence. That would help, or UK if you can find one. That they will kind of appreciate it better. What I have found in situations like yours, especially at an early stage, is when you go to a pure Indian VC who just has a presence in India, they tend to say that I don't know much about that market. Why don't you get a co-investor who just to give an example, looks like Inventus, okay, which has presence on both sides. So a better approach to start off with, and at an early stage you should try and approach a few investors because you improve your chances. But start off with people who have presence on both sides of the border, ideally UK as well should come into the equation.
Our next question is from Kushali. Says valuation in case of startups seems to be quite subjective at times. What's a good range to work with in case of a pre-revenue or 1 year into business companies? Does Inventus invest in such companies?
Okay, so Kushali, you should know that valuation, even for reasonably advanced companies, at times is fairly subjective. I mean, you can see what happened to Facebook, you can see what happened to LinkedIn on the other side, etc., etc. So it is, I mean, even for established companies, it is not a science. There are elements of art. When it comes to early stage companies, it becomes even more art than at a advanced stage when Facebook is publicly listed, or a LinkedIn publicly listed, or just average publicly listed, for example. There is, I think the reality is that early stage valuations are subjective, call it subjective, call it art, call it lack of science, but that is the reality of the situation. So you would end up working with thumb rules, and I think the thumb rules eventually boil down to what percentage of the company do you feel comfortable giving away at that stage for a certain sum of money. So that is what you should work with. I should say that our focus as Inventors is not exactly on pre-revenue companies. You did say it was a product company, so I will, I mean, the specific questions without knowing the answers to some of the follow-up questions, I would say that in some product companies we have gone in at a pre-revenue stage. But we would at least want to see if it is an enterprise product, a beta with a potential customer, for example, or if it is a consumer-oriented product, then something that we can keep the ties around, touch and feel, etc. That's the stage at which we, speaking for inventors, would feel.
So, Parag, that was the last question for the day. Thank you so much for that very interesting session. Thank you to all our attendees for participating in the webinar. We are glad that the questions kept coming in, but due to lack of time, we cannot answer all of them. Please do send in your feedback and suggestions to us at eclub@nenglobal.org. And if you found the session interesting, feel free to blog or post about it. The recorded version of the webinar will be available on our YouTube channel by the end of this week. NEN Entrepreneur Support and Training is conducting a one-day workshop for entrepreneurs on raising fund in Pune on June 29th. The details are up on nenonline.tv. NEN is conducting its second online mentoring clinic on getting customers online faster and cheaper this Friday from 2:30. The details are up on nenonline.tv. Also join us for our next webinar on strategy for startups by Professor Gurudas from Symbiosis on July 3rd at 3 p.m. Thank you once again.